Well, the IRS tax code is full of thousands of sections, each with its own specific definitions and rules and, yes, fees. And guess what? Taxpayers are legally bound to follow the tax code. Now, we all know that we need to file our taxes every year, even though it can feel a little overwhelming and complicated, but you say there's a more proactive approach that pre-retirees should take. We're going to dive into that. This is Retire Colorado with Alicia and Josh Lewis. I'm Bruce Steinbrock. Reach out to the Lehman Lewis Financial Team, 970-446-1234, or you can go to lehmanlewis.com on the web and check out the beautiful website that Alicia, Josh, and the team have prepared for you. All right, Alicia, let's explain the difference between getting our taxes prepared and actually planning for taxes.
No, this is such a good one. So when we're talking about getting, some people come in and they're like, yeah, I'm getting my taxes done right now. We're like, tell us a little bit about that. What does that look like in the process? I would say 90% of people who come into the office, would you agree with this? Maybe 90% of people that come in, They are working with a tax preparer. So that's where you give them the numbers and they put the numbers in the boxes. It's where people are looking in the rear view mirror and not through the windshield. And so when we are, looking at tax strategy, of course, that's important. What happened last year, we want to make sure that it's done correctly and all of that. But what we're looking at is how can we look ahead, right? How can we look at, not only this year, but 5 years, 10 years, 20 years down the road, because ultimately the most powerful tax strategy is to plan now for the future rather than, the reactive of like, oh shoot, what happened last year and what taxes do we owe? You should never be questioning what taxes do we owe. You should already know that. And ultimately you should be trying to, again, like I said, plan ahead so that you have less taxes in the future because taxes are on sale right now. So taking advantage of some of the tax strategies that we have available right now, it's just an incredible way to kind of get ahead.
Yeah. And if you're one of those that has a great Excel spreadsheet, hey, fantastic. That's only part of the the plan when it comes down to it, Josh. When should we really start thinking about taxes, especially as it pertains to retirement income planning?
Yeah, I would say think about it early, think about it often. Little tongue in cheek.
I wish
but
Congress
I think,
would do that because they don't seem to.
Oh, they have plenty of time, right? We'll worry about that shutdown this afternoon. So I think, when you kind of look at that timeline of retirement, and if you're, say, 5 years out or so, that's when you want to kind of dial in on that tax plan, because then you're able to look at kind of maybe winding it out with some of those working years, also getting things maybe shifted around, look at different income thresholds. So depending on, how much maybe your income situation might change when you leave your employer, you're going to be ready to sort of pull the trigger and implement some of those strategies. If you're already in retirement, kind of time is of the essence. And you want to look at things maybe from a market-driven sort of scenario. You also want to look at it maybe from an income-driven scenario. If you haven't filed for Social Security yet, you have that much less taxable income coming in. So it might be a good time to strategize some of the tax planning. So, everybody's situation is going to be a little bit different. But I think if you're still working and you're looking at kind of the exit sign 3 to 5 years out from now, it's a really good opportunity to kind of get ahead of some of that planning now and get your ducks in a row, knowing that, hey, this current legislation where tax rates are at now is likely going to go really through 2028. I know they said it's permanent. If you guys know how Congress works, it's permanent, maybe 2 to 4 years at a clip. So it's not a forever sort of thing. So looking at kind of where we're at just in terms of legislation, sort of match that up with your own time horizon and look at, that 3 to 5 year window, especially if you're currently employed. But for all of you folks who are currently retired, now is a great opportunity to look at your taxes and start planning for, tax-free income in the future.
Yeah, no doubt. The debt just piling up and up and up. As Josh said, taxes are permanent, or tax breaks are permanent until they're not. And so you want to prepare for all of that. We invite you to reach out, 970-446-1234. You can also explore more about Alicia, Josh, and the Lehman Lewis team on the website, lehmanlewis.com. Check on events that are coming up, just all of it, lehmanlewis.com on the web. Alicia, the tax code is never set in stone. Now, again, they can use words like permanent, and it just is hollow. Because, again, there's one administration to another, and Congress will change as well. I mean, obviously, the House of Representatives, they're always running every 2 years. For a senator, you're there for 6 years. And we're talking about Washington. Now, how important is it to take advantage of planning, especially with the One Big Beautiful Bill that did extend through 2028 that we know of, the historically low taxes, and really take advantage of that before, they're gone, because we were doing that with the Tax Cut and Jobs Act for a long time. The end of, 25 was when you had to take advantage. Now you got more time.
Yeah, I mean, it is the perfect time to continue to take advantage, right? Because here we thought that, this was going to sunset in 2026. And so we've kind of been rushing around the past several years trying to get everybody in line with the tax strategies. And so now this just extends it and allows us to have a little bit more breathing room. But it's absolutely true. It's not forever, right? And so we want to take advantage of it, make hay while the sun is shining, right? And so really focusing in on creating that plan. And, I think more than anything, people need to know what's available. And I think that that's the hard thing sometimes when you're not working with somebody who is really centrically planning around retirement. A lot of people say, oh, I have an advisor that I'm working with, and, they're helping me with my retirement. But a lot of times, and great people, great advisors, but a lot of times what we're seeing is that people are helping them save for retirement, right? And that's a great place to be. But when you are in retirement or 5 to 10 years from retirement, the strategy is completely different, because now you've built this nest egg. How do you distribute the money? How do you take income off of that? How do you make sure that it's most tax efficient? How do you do all of those things? So it's not just about what investment should you be in. There's a lot more to it. And so, and really looking at the here and now of the legislation that is happening, the tax benefits that we have, they go with retirement. That is a lot of what we're dealing with right now. I would say some of the people that benefit the most is retirees. And so looking at that and really helping them guide, through that and plan for that in the future, it could make all the difference. And not only for you and your future, but also how the money is left to your heirs and, whoever you want that money to be left to. So it is really important to make sure that you know what's going on and work with somebody who knows what's going on and that can help position you in the best way for you. I mean, and again, or hopefully the best way for you, right? Because there's no such thing as the best way for one individual. It all comes down to looking at your situation, looking at your strategy, and honing in on what is going to be the strategy that is most beneficial.
Yeah, no doubt. Josh, I want to talk about RMDs here a little bit, because a lot of people may or may not understand them. We've moved the football, if you will, several times. You had to take a required minimum distribution at 70.5. Then they moved it to 72. It's currently 73. If you're born after 1960, then it's 75. And so people get confused, when do I have to do this? But you can also cause yourself a huge tax burden if you're not careful. So talk about RMDs and the impact they can have on retirement taxes.
Yeah, this is a big deal for a lot of clients. When you look kind of, fun fact of the day, broad swath of Americans, our second largest asset is our 401k, so our employer plans. So when you look at kind of where we save and invest money, most of that money is in a tax deferred account, which is going to be subjected to required minimum distribution. So we save, we invest, we let that money grow, and then, we get to retirement age and we have to start taking money out of those accounts. All of that money, because it is tax deferred, is taxed like ordinary income. So what happens to a lot of folks, maybe they have a good income situation, they paid off a lot of debt, have relatively low expenses, good Social Security benefits, all of those things. They hit that age of 73 and all of a sudden, their $2 million IRA is now going to subject them to about $70,000 of additional taxable income. So you're required to take out a set percentage of the total value of those IRAs in that specific year. And this goes on for your lifetime. So what happens with a lot of folks who haven't planned or haven't really looked at kind of their income needs or where they're taking income from, all of those things, more often than not, they end up getting sort of sucker punched with a bunch of taxable income. So they're likely jumping a tax bracket, maybe two, depending. And then a lot of times they're also going to move up a tier in IRMAA. So they're end up paying more on their Medicare Part B and D premiums. And it also means that taxation on their Social Security is likely to increase. So all of these things kind of compound on one another. And generally speaking, it becomes a little more cost prohibitive because everything sort of in our tax code is based on income. And the higher the income goes, the higher your tax liability and IRMAA liabilities are going to go as well. So it's kind of generally an unpleasant surprise when people look at the impact of what those required minimum distributions mean, especially when they haven't planned for it.
Folks, Alicia, Josh, and the team look at retirement income planning holistically. So again, we're covering a lot about taxes here today, but that's just one of the 5 components that go into a true retirement income plan. First, you have to have income. It's the engine that drives your retirement bus. Without it, you're somewhat dead in the water or stuck on the side of the road with no gas, right? You also have to have an investment plan. There still has to be money growing. We're talking about taxes. You have to have a tax plan. How is it all going to work together? What is tax-free money? Maybe you've rolled some into Roth. What is still a required minimum distribution that is going to get taxed at some point in time? You have to have a health care and a legacy plan as well. It's all 5 parts coming together for your retirement. Reach out today and start the conversation, 970-446-1234, or you can go to laymanlewis.com. We'll continue the conversation on the other side of the break. This is Retire Colorado.